name is Maria Smirnova, and I am a Senior Portfolio Manager at Sprott Asset Management. I am here today with Shree Kargutkar, who is a Portfolio Manager at Sprott Asset Management. Today is January 24th, and we will discuss the Ninepoint Gold and Precious Minerals Fund, the Ninepoint Silver Equities class, and the outlook for both silver and gold. And today, looking at slide 1, our objective is to cover a number of subjects. We'd like to recap what happened last year. We'd like to look at what's happening in the macroeconomic environment right now. We'd like to talk about gold and silver and the respective equities. We'd like to provide you a silver update and our fund updates, and we'd like to give you an outlook for what we think will happen in the future. So looking at slide 2, let's quickly recap some of the major events of last year. Looking at the US stock market as the barometer of investment sentiment, while 2017 saw the lowest market volatility since the 1960s and the smallest drawdown on record, 2018 brought with it a roller coaster for investors. The first quarter and the fourth quarter both experienced sell-offs, with the latter being the worst Q4 since 2008. The S&P ended the year down 4.4%, which was the first drawdown since 2008, with record volatility documented for any calendar year. In early July, President Donald Trump followed through on months of threats to impose sweeping tariffs on China for its alleged unfair trade practices. So far, the US has already slapped tariffs on $250 billion worth of Chinese products and has threatened tariffs on $267 billion more. China, for its part, has set tariffs on $110 billion worth of U.S. goods and is threatening qualitative measures that would affect U.S. businesses operating in China. Trump's tax package came into effect, with the biggest change being that the corporate tax rate being lowered from 35% to 21%, benefiting mostly corporations and their shareholders through share buybacks and dividends. The Federal Reserve continued on the course of raising its benchmark interest rate. Bitcoin, after soaring an incredible 1,400% in 2017, plunged 74% to end 2018 at around $3,700 per coin. It took the whole cryptocurrency sector with it, although not before it was able to suck capital out of the hands of many investors in the form of initial coin offerings. Up in our neck of the woods, Trudeau's government came through on their promise of legalizing cannabis and creating a new industry in the process. Meanwhile, gold and silver in the miners did not attract much attention and quietly rallied at the end of the year after shaking off record levels of short interest in the futures market. Moving on to slide 3, and continuing our review of last year, we're looking at a chart showing 10 different asset classes and their annual historic returns. Last year, gold outperformed all but one of those asset classes, once again proving its worth as the store of value during volatile times. In fact, gold rose 7.7% in the fourth quarter, precisely when the market melted down. Not surprisingly, we're hearing more and more well-known investors talk once again of gold's invaluable properties of being an investment portfolio hedge. Moving on to slide 4, since the United States is so influential on the world stage, and since gold is priced in US dollars, and takes a lot of its cues from the state of the U.S. economy, let's spend a bit more time discussing our neighbor south of the border and its current macroeconomic state. This is a chart showing real GDP growth together with the federal funds interest rate. The first observation I would point is that real GDP growth has been lower in recent years than in prior decades. The second observation is that interest rates have never before been at or close to zero, as in the past several years. The monetary easing that the Fed instituted post the global financial crisis was designed to stimulate the economy, and it did, but not with blockbuster results. Last year's tax cuts did manage to boost the U.S. economy, but we expect the sugar high of those cuts to wear off, and the headwinds of higher interest rates and trade wars to slow growth. Globally, the International Monetary Fund has recently revised its forecast for global economic growth this year and next. And the IMF Managing Director Christine Lagarde was quoted as saying that the world economy is growing more slowly than expected and risks are rising. In the past, central banks have been able to fight economic slowdowns by lowering interest rates in order to stimulate lending, which in turn would encourage investment. But what happened in the last easing cycle is that companies borrowed money but used a lot of the proceeds for share buybacks and dividend payments. Similarly, Trump's administration predicted that the tax package would not only pay for itself, but would cut the deficits by $1 trillion. As we will see in the upcoming slides, that prediction did not materialize. Instead, the tax cuts heavily benefited the wealthy and resulted in more share buybacks, which surpassed $1 trillion last year. What we're seeing right now are signs of a slowdown, as I will discuss in a couple of slides. Moving on to slide 5, here's another look at interest rates, but this time together with the United States budget balance. In the past, the Fed has eased monetary conditions when the government's budget deteriorated. But this time, the Fed is tightening directly into the teeth of an exploding deficit. It is a matter of time before one of the two forces reverses course. And we would suggest wagering on the sudden reversal of the surging federal deficit is a losing proposition. On slide 6, and taking our thinking one step further, we see a strong inverse correlation between the dollar and the rising budget deficits. The US dollar has strengthened in recent years on the back of a strong economy and the expectation that the Fed will raise interest rates while other countries do not. Going forward, the Office of Management and Budget project deficits of $1 trillion, up from current $800 billion. Assuming the relationship continues to hold, we believe the dollar is bound to weaken. Moving on to slide 7, as I alluded to before, the economy is sputtering despite relatively little tightening over the last couple of years, and the fiscal stimulus of tax cuts. Looking at the ISM manufacturing new orders as a measure to predict EPS growth, new orders have declined and are indicating a slowdown is coming in earnings growth. Furthermore, the impact of higher interest rates has not been fully digested yet, as there's about an 18-month lag between changes in interest rates and economic conditions. On slide 8, on the consumer end of the leading indicators that can be looked at is housing. What we're seeing is that home builder confidence is down. The National Association of Home Builders Sentiment Index is plunging on the left graph, and consumer sentiment towards housing is near all-time lows, as seen on the right graph. Indeed, in December, home sales tumbled to their lowest level since 2015. They were down 10.3% year over year. This does not bode well for the overall economy or cyclical assets in the quarters ahead, as there's a historic relationship between the housing sentiment and the broader economy. We're now beginning to feel the effects of 2 years of rising interest rates. So what do we think the Fed will do going forward? At the end of past cycles, the 10-year rate ended up in the same place as the federal funds rate. In other words, the curve flattened completely, and in fact, it almost always inverted, the only exception being 1995 when it came within just a handful of basis points. This is normal, it's how the bond market works, and there's no reason to expect anything different this time. There's also been a sea change in Fed rhetoric since December. By unanimous decision at its December 19th meeting, the Federal Open Market Committee hiked the Fed funds rate by 25 basis points. During the latest meeting, members of the FOMC voiced their expectations of economic growth slowing in the medium term. Reasons for this view were recent financial market developments, softening in foreign economic growth, and a more pessimistic outlook for housing sector activity. The key statement in the latest meeting minutes was, "We are not on autopilot. The Fed is definitely paying attention." On January 15th, the Fed's most ardent hawk, Kansas City Fed President Esther George, said, "It might be a good time to pause our interest rate normalization." Gold will rally as the market recognizes that the current tightening cycle has reached its conclusion. And now I will hand it over to Shree.
So looking at slide number 10 and 11, both the slides are showing the speculative short interest levels that are graphed against the price of gold and silver. So on slide number 10, you can see in blue the CFTC non-commercial gold shorts. These are speculative shorts. And in gold, you see the price of gold graphed against it. It is no surprise that surges in short interest levels for both gold and silver coincide with a near-term low of the metal price. As you may recall, gold declined for 6 straight months from April all the way to September. Therefore, it was very encouraging to see gold hold near $1,175 last year, while gold shorts increased to a record high. Gold regained the $1,200 level very shortly thereafter, and it currently sits near $1,280. The $1,300 level on gold is very important because near $1,300 and above that, many of the gold mining companies that we follow become exceptionally profitable. Slide number 12 lays out our gold investment thesis. As we all know, gold equities and volatility go hand in hand. But historically, the rewards of the volatility that has coincided with investing in the gold space has been worth the reward. From 1982 all the way to 1997, the gold equities rose by 760%. Similarly, from 2000 to 2011, gold equities gained over 600% over this time frame. The declines have also been sharp. For example, gold equities dropped by 80% during the previous bear market, which began in 2011 and ended, by our measure, towards the end of 2015. Similarly, gold equities declined by 76% from 1996 to 2000 and by 80% from 1980 and 1982. December 2015 marked an important low, and according to the valuation work that we have done, which is on slide number 13, we believe that along with a very important low being established, the fundamentals in the gold space have improved materially. The long-term gold equity to gold bullion ratio is currently trading near the 5th percentile, and the price to cash flow multiples in the gold space are also close to the 5th percentile, something that we have not seen since 2010. Near $1,300 per ounce, the free cash flow for several of the companies that we track inflects materially. And this marks a very important turning point for the gold space, because above $1,300, you are in a scenario where several of the gold companies are fundamentally cheap, and we're also having the bottom in gold, as well as the gold equities being put behind us. And now I'll hand it over to Maria to discuss silver.
Thank you, Shree. Some of you may have already heard me speak about silver in the past. However, I'd like to provide an update and speak about some of the latest developments in the sector. Silver continued to underperform gold last year due to a lack of investor interest. This led the gold to silver ratio to stay elevated at more than 80-1. I'd like to remind our viewers that the ratio hit 84-1 in the 2008 financial crisis, and silver appreciated fivefold over the next 2.5 years. The gold to silver ratio tends to decline during gold bull markets, and I do think that silver represents a significant investment opportunity at the present time. And I will reiterate that we believe that if gold goes on a material run, we think that silver will definitely outperform gold at that time. Moving on to slide 15, this is a very high level fundamental view of the silver market. So looking at the price of silver, it is easy to assume that something terrible is happening in the supply-demand balance of the metal. Either supply is soaring or demand is crumbling. In fact, the low price has been caused by one factor in my mind, and that is a lack of investor and particularly retail investor interest. Sales of coins and bars fell both in 2016 and 2017, led by declines in North America on the back of rising appetite for riskier assets and growing optimism about the economic outlook. We expect global demand from this sector to continue to retreat last year, but to start growing again this year, as economic uncertainty and increased volatility on equity markets drive investors back to safe haven alternatives. And we're already seeing signs of that in the beginning of this year. Looking at some of the other lines on the slide, supply has shrunk in the last few years, both on the mine end and on the scrap end. There's no central bank selling still. And on the demand end, industrial demand has been stable. And on slide 16, I would like to highlight the fastest growing segment of silver demand, and that is photovoltaics or solar. This is the area where silver consumption is experiencing the most growth. Last year, installations worldwide grew 10%, and I'm expecting the amount of silver used to surpass 100 million ounces last year. The total installed capacity of PV systems in China topped 165 gigawatts at the end of September. That means that the 2020 target of 105 gigawatts, originally conceived by the government, has already been exceeded by more than 50%. China's National Energy Agency is thinking of revising up the 2020 target for solar energy to at least 210 gigawatts. The target may even be raised to between 250 and 270 gigawatts to support the Chinese solar module industry. China is not alone, as India also has a target for solar capacity, and the European Union last year raised its target for how much energy it sources from renewable energy from 27 to 32% by year 2030. While solar underpins industrial demand, we now need investment demand to return to send the silver price much, much higher. And moving on to slide 17, just like in gold equities, we see very depressed valuations. We see the same thing happening in silver valuations, as we see equities trading at low price to cash flow multiples as seen in the historic context. So again, once silver price picks up, these equities will attract new investor interest. And now I will hand it back to Shree for a discussion of our funds and an outlook.
Thank you, Maria. We'll start off on slide number 18, which highlights our core philosophy. We believe that both gold and silver have been historical stores of value. They're both an established alternative asset class. And as the fourth quarter of 2019 has shown, both of them have been excellent at providing diversification benefits against traditional asset classes such as equities and bonds. To highlight, in Q4, while the S&P 500 declined by 13.5% and the NASDAQ dropped by 17.5%, gold appreciated by 7.7%, and the GDX, which is a widely followed gold ETF, appreciated by 17% in the quarter alone. Gold equities, as we have shown before, have provided massive leverage to increasing gold prices. And as we said before, above $1,300 an ounce, gold equities come into significant favor as the fundamentals shift for them materially. At the Ninepoint Gold and Precious Minerals Fund, we have always focused on having a global exposure. Because we have a significant amount of exposure, not only in North American equities, but also in Australian equities, as well as London-listed stocks. We try and capture the entire value chain of the mining industry, beginning from exploration companies all the way through development stage companies and into producing companies. We've used the portfolio from a tactical perspective to try and capture the most amount of upside through positioning as well as options in order to limit the portfolio beta. Slide number 19 illustrates the performance of the Ninepoint Gold and Precious Minerals Fund. The number that is worth highlighting here is a 3-year number because, as we said before, the end of 2015, so December 2015, marked a very important inflection point for precious metals investing. And over the last 3 years, the fund has appreciated by 12.3%. On a longer term basis, so 5 and 10-year basis, we have shown to our investors our ability to outperform the benchmark through adding alpha against the index. Slide number 20 shows the performance of the Ninepoint Silver Equities Class Fund, which has looked to provide investors with exposure towards silver equities. And over the past 3 years, it has returned 12.4% for the investors. Slide number 21 goes over the outlook for both our mandates, which is the Ninepoint Gold and Precious Minerals Fund, as well as the Ninepoint Silver Equities Class Fund. So as we discussed previously, the economy is at an inflection point. We believe that gold and silver are positioned very positively going forward because throughout 2019, we expect the trade tensions between the US and China to continue. The US political picture is only going to get worse from where it is right now, and this is likely to add additional drag to an economy which is already softening. US housing market, which is a very important part of the US economy, is looking more and more tenuous by the day, and we expect the softening to continue. Leading indicators in the economy, as Maria discussed, have been soft as a result of weakening equity markets and global trade worries, and these indicators are likely a harbinger of further economic weakness, not only in the US, but also in Canada and the rest of the world. global political tensions, such as what we're witnessing between China and the US, as well as China and Canada, are not going to improve anytime soon, and this is likely to feed further investor angst. And China will continue to try to stimulate its flagging economy. However, with all the tensions surrounding the equity markets, the economy around the world, this will likely prove to be in vain. So our view overall has been that the US dollar has peaked along with the US economy. The US debt will continue to grow, and as the geopolitical tensions rise, the buyers of the US debt, which have traditionally been the likes of China, will likely step away, making US debt more and more burdensome for the government to carry. The volatility and uncertainty, which came back towards the fourth quarter of 2018, has persisted, and we believe it will continue to persist throughout 2019. And as a result of all of the above, gold's allure in 2019 is looking quite exceptional, because for investors, gold has offered a very important diversification tool. And above $1,300, and we are very close to that right now, for gold equities begin to appear significantly cheap versus not only the S&P 500, but virtually every single asset class out there. There's tremendous upside in the gold and silver equities that our funds are invested in. The portfolio of the companies that are currently in production have very significant free cash flow profiles that will benefit our investors going forward.
I think that wraps it up. Thank you for your time today.